Hi, everyone. Thanks for joining today. I'm here with CJ, Klaas, and Jeff, who we'll get to in just a moment. Today's topic of discussion is everyone's favorite insurance and long-term care planning as part of our Klaas U webinar series. Got a few people still popping in, but I think we're ready to get started. Few housekeeping details today. So as we're running through the presentation, Jeff is going to guide us through a lot of great information here. We'll take a Q&A session at the end with the full time probably taking right about 45 minutes, give or take. Feel free to use that Q&A button at the bottom of the screen to submit your questions. And while we won't stop during the presentation to hit it, we'll circle back at the end to make sure that everyone's questions are answered either by the presentation itself or at the end. So feel free to submit those anytime you'd like. And as a quick reminder, this session is recorded. We will send out recording to you at the end. And thanks for joining us. So let's get started. CJ, if you want to jump in.
Sure. Yeah, so on with us today is Alyssa. She's one of our certified financial planners, one of our advisors at Klaas Financial. Also on with us is Jeff Hess from the Palladium Group. More to come on Jeff in a little bit here as we get further into the presentation. And then my name is CJ Klaas, again, one of the advisors, and act as part of the leadership team at the firm. Go ahead and go to the next slide. So a couple things about Klaas Financial before we get started here is Klaas Financial has about 1,160 households that they work with across the country. We have 25 employees across 2 different locations, and then we operate in 32 different, or I should say we have clients in 32 different states. We have offices in both Illinois and Wisconsin. One thing I want to draw your attention to is that 50 years in business. As of this year, Klaas Financial turned 50 years old. The business was actually founded by my father and his brother right out of college back in 1976. So it's kind of a, obviously very near and dear to my heart, given that I grew up around the business. But it's a big milestone. Looking at some of the data on the number of businesses that make it to the 50-year mark, it's a pretty small group of businesses. All right, next slide. So this is important. I want you all to understand, who Jeff Hess is, who the Palladium Group is in relation to Klaas Financial. So you all should know that we operate with you all, helping you both plan and invest for the future. So within that context, we have to work with other financial professionals, or what we often refer to as other financial team members, to help carry out your overall financial plan. We may help you invest some of your retirement dollars. We may suggest that you get a certain type of a loan or a certain type of a mortgage for something. We may suggest you get a will or a trust put into place, but we don't have all those experts on staff, obviously. And so a few years ago, we developed something called our Klaas Professional Network. That's what you see on the left side of your screen there, which is just kind of a visualization of we work with all these different professionals. We've actually created a condensed list of who those professionals are in each state that we operate. So one for a grouping of professionals in Illinois, grouping of professionals in the Madison, Wisconsin area. And so it covers a lot of these areas: real estate, attorneys, accountants, insurance agents, independent trust professionals, so on and so forth, which brings us to Jeff and the Palladium Group. One of the reasons we've chosen to partner with the Palladium Group inside of our Klaas Professional Network is because of how the Palladium Group specifically operates. You can see it down there in the definition, but they are a team within Ash Brokerage that works specifically with fee-only advisors and family offices who operate in this kind of fee-only capacity, which is what Klaas Financial does. This is critical because we want to work with an insurance agency that operates through the lens of giving advice, not selling. That's the key. Lens of giving advice, not selling. So you'll notice as you go through this, as you hear Jeff talk, and if you've ever engaged with Jeff or do engage with Jeff and his team in the future, it's a completely different way to engage the insurance industry. It is much more consultative than salesy. Okay, next slide. So just quick introduction on who Jeff is, and then I'm going to turn it over to him for the meat of our presentation today. Jeff is married with 5 children. He lives in Indianapolis. He was born in Milwaukee, which means he's a lifelong Badger fan, which for us up here in the Madison, Wisconsin market means a lot to us. He does endurance events like marathons and triathlons. He has 25 years of experience in the insurance industry and has been working in this kind of consultative fee-only capacity with firms like us for the last 15 years. So has a lot of experience on the consultative side of insurance over the last 15 years. So with that, Jeff, I'm going to turn it over to you.
Great. Thanks, Alyssa, and thanks, CJ, for the introduction, and for everybody listening. Thank you for the time this afternoon. I'm looking forward to it and appreciate the opportunity. It is interesting, as CJ talked a little bit about my background. I actually came into this side of the business after having formerly been more on a sales side. That didn't last long because of how it was structured. It really shaped my opinion and felt like insurance was being sold and then planning was being done later. And I felt very quickly that was sort of backwards. So hence the transition to where I am today. So as I talk today, I really want to follow these 3 points within the agenda. And you'll notice point number 1, it really, as we're talking about insurance and long-term care planning being a real important word in that, I don't want to just focus on product. We will talk product throughout because that is part of how you do financial planning. There are products and solutions along the way. So I'm going to talk more so in different stages of life. So whether in your 30s, 40s, 50s, 60s, 70s, we'll talk about those different stages and how these products fit in there, what to look for, how you might implement it, and things like that. Talk about potential gimmicks or potential shiny objects, things that you might see on social media, you might see in presentations from other advisors in the news. So I'll touch on those, and then a deeper dive into long-term care planning as well, because that's a big topic that's really just continues to grow over the last 10 to 15 years. So we go to the next slide. So some of you may have seen a pyramid similar to this. This is a pretty classic financial planning pyramid that shows really the foundation and the different steps along the way. You can't do estate planning if you haven't already done some sort of cash flow analysis, risk management, and things like that. And so number 1 down there at the bottom, financial position, sometimes referred to as cash flow. Obviously, if you don't have cash or cash flow, there's not a lot of financial planning that can be done. And so cash flow is critical to driving the financial plan. And then insurance is an important piece to help protect the plan and mitigate or manage some of that risk. Doesn't mean insurance is always necessary, but it's a big part of the conversation that we have. Of course, I have every day because I live in this space, but it's an important consideration to help protect the financial plan. And we'll touch on that as we talk about these different stages of life as well. So as we can go to the next slide, I think. Yeah, so as we think about this in terms of the early stage of our lives, or at least the working years of our lives in the 30s and 40s, life insurance is oftentimes the automatic sort of question. What kind of life insurance should I have? What type of life insurance should I purchase? Should I have life insurance? How much? All of those questions. And rightfully so. As I talked about before, if you can have the cash, you can even have the cash coming in, but if something happens and if you're married, you or your spouse passes away, well, that cash flow is now cut off, or potential somebody who is at home taking care of children. Now we need to bring in a care provider or pay for daycare. So having insurance, life insurance, is a key component to sustaining a financial plan. Oftentimes I get the question of, instead of permanent insurance, it's usually, should I consider term life or whole life? But whole life is just a component or one option within the greater umbrella of permanent insurance. And probably the reason I get that question of whole life and not permanent is because decades ago, whole life was the primary permanent insurance. Um, Within permanent insurance, there is whole life, universal life, variable, and indexed universal life. So it covers a pretty broad spectrum. We're not going to get into the details of those right now, but um, in terms of what is right, I will just say, generally speaking, term insurance in these early years, working years, is usually 95% of the time what is recommended and implemented, maybe even greater than that, primarily because the premiums are lower. The premiums are level for most plans. Having said that, there are a couple of companies that offer increasing premium term options. Those can seem attractive because they are a little bit cheaper in the first couple of years, but generally by years 5, 6, 7-ish, those premiums that they are now higher than the original level premium term contracts out there. So if you're ever shown or ever see these increasing premium term contracts, um, I would advise take a look at the whole market and look at a level premium contract. But term insurance is attractive because the premiums are lower. It's designed for a specific need: pay off mortgage, credit card, if you still have debt from college, medical school, things like that. Provide for funding for college. If you've got children, it helps provide the funds for that or their activities, things like that. So it provides for that temporary, shorter term need. And when I say shorter term, I'm thinking maybe 10 to 20 years. We can go out 30 years. I generally see 20 years being probably the most common. But it can be customized to fit within the financial need. So as Klaas goes through your financial plan and you see a shortfall, if there's a death of one spouse or death of one person, we can mirror that with a 10 and a 20-year term contract. So maybe what we call laddering those contracts to sort of fit where that deficit or that need would arise. One thing that one question that always comes up, and I'm a big proponent of at least asking and having the conversation, is will this or could it be important to convert a term policy to a permanent policy at some point in the future? If you're not familiar with this, a conversion is simply converting term to permanent without evidence of medical insurability. So if you purchase a 20-year term policy and you're 15 years in and you have conversion options, you could convert that term policy to a permanent policy without the insurance company looking at your medical records. So you could truly have significant health history or fully uninsurable in the traditional underwriting sense, but they're not going to consider that because it's a convertible term policy. Now, it's important to know, you don't have to be the expert, of course, but it's important that the person you're talking to knows which companies offer strong conversion options, and which companies have strong permanent products and a strong financial rating in order to convert those in the future. So that's term insurance. As I said, we see that the bulk of the time. Permanent insurance, we'll see it periodically. It is, as it states, permanent, so more longer duration, age 90, 95, lifetime, these lifetime goals. It requires higher premium because it is permanent, and in many cases, it can build cash value. Again, this is a much longer and deeper conversation, but there are a few cases and scenarios where somebody who is an ultra high income earner, they've maxed out 401k, IRAs or Roth IRAs, and they're looking at another way to invest their money in a vehicle that can defer taxes. And permanent life insurance offers this tax wrapper, is sort of how we describe it. The cash value within the permanent policy grows on a tax deferred basis, and you can pull it out income tax free if it's done correctly. Now, again, it's not very common that this occurs, but it can be done, and it can be utilized. It's certainly not a replacement for Roth IRAs and 401ks and other um, phenomenal retirement accounts. That CJ and Alyssa would certainly agree. Maximize those opportunities first. So, but so that's kind of the landscape in terms of term insurance and permanent insurance. I think we can go to the next
Let
slide.
me actually just jump in here quick if you don't mind, Jeff.
Sure.
So everybody, just a quick, simple example of this. I am married. I have three young children. One is in college, and two others will, Lord willing, eventually go to college. Um, I am a part business owner. So if and my spouse stays at home with our children. If I were to die, there are many years worth of income and expenses that are lost relative to my death. So here's a simple example. For me, probably need a bunch of term insurance to cover the gap between now and when those children will be older, the mortgage is paid off. I have earned enough to diversify outside into liquid investment accounts, but eventually that window, it may not be completely gone where the risk of my death isn't there, but you can imagine if I'm retired, my kids are out of the house, I have no debt of any kind, I've got plenty of investments because I've, dealt wisely with Alyssa at Klaas Financial. You get the idea that ultimately there's this notion of like, yeah, my need for basic life insurance could eventually go away. So that's what kind of Jeff is getting at here. That's why often in these 30s and 40s, people will get that term insurance. Now, as Jeff just said, I want to hit on one other thing, which is the permanent insurance side of things. Where we see permanent insurance going wrong is when it's a first means of like saving, right? So people say, oh, I'm getting older and I want to convert term into permanent, or I want to start saving more cash into something that defers taxation. We get it. I mean, again, we are formally trained to understand these products and how they can benefit you, but it should be in an ordering, right? Are you maxing out your 401k plan? Are you doing backdoor Roth IRA contributions? Are you paying down your mortgage? There's this listing of all these other things that are much higher in the priority list. If we get down to the bottom and it's still like, I still have excess cash flow and I have a need for not having any passive income through dividends and interest of a taxable account, great, fantastic. But as Jeff can attest, that's a smaller percentage of society that actually applies to. And unfortunately, we sometimes see that permanent insurance oversold and it creates problems later on.
Yeah. Yeah, CJ, you're spot on with that, and oversold and sold incorrectly. And you mentioned the order in which things should be addressed. This slide here addresses one of those. Some of you may have seen this "be your own banker" or infinite banking concept out there. I have this circle with a line through it because the whole, again, we could spend a lot more time on this, but the whole concept is for you, rather than utilizing a bank for loans or any other lender, is to utilize life insurance for that. So in other words, put all of your cash into a large life insurance policy. Yes, it grows tax deferred, but you can borrow from that at a lower interest rate. So you're quote unquote your own banker, but you put everything, literally everything, into one basket. Um, we are not advocates of this. As CJ alluded to, I think there's a place for permanent insurance and cash value, but we got to look at the bigger picture and bigger goals and strategies and planning. So if you ever see something like this, yes, the illustrations look great, but I would get a second opinion on that. So we can go to the next slide. The other component of this, I mentioned at the very beginning, cash flow is the driver of a financial plan. One area that I have seen in my career in the insurance space probably not get addressed enough is disability insurance because cash flow is the driver for the financial plan. Now, as a guy, I think I'm pretty healthy. as CJ said, I do endurance events, so I'm invincible. I'm not going to get disabled. I don't need disability insurance. I kind of joke there, but that's sometimes the mentality. We don't hear it directly, but that's kind of what we end up sort of reading between the lines. Now, not in all cases. I get that premiums, like you can only pay so much in premiums between auto, home, health, life, all of these premiums. But what I will say is, Alyssa, if you want to just click the next button, you'll see with if you become disabled and you can no longer work, it's not that you just don't have a paycheck coming in to live day to day. You can no longer fund your 401k, go on vacations, put away money for 529 plans, give to charity, your kids' sporting events or activities, musicals, things like that. So it's not just living day to day, it's funding all of these other things that are part of the greater financial plan. So I want to end on the 30s and 40s by saying disability insurance is a big component of a greater financial plan, or at least the conversation of disability income. So we can move into now as
Jeff,
we sort of.
Jeff, can you speak to? I heard somebody say one time you're 4 times more likely to become disabled than you are to die, or something to that effect. I don't know if you know what the numbers are, but I think this is a component of what you're getting at is if the death stops the income creation, and that's the thing that we're concerned about, why we need life insurance, term life insurance when we're young. Well, we should ask the question of, is there anything else that would stop the income besides death? I think that's what I'm hearing you say. And the answer is like, oh, yeah, disability. And that actually is a much higher probability event than your actual demise. And it kind of acts in this middle ground where, from an income standpoint, it's as though you have died, right?
Yeah.
But you're still alive and you represent a cost. So it's a really, if you've ever had friends or family members end up in this place, it's brutal. It's really, really brutal. So anyway, just want to encourage you all. By the way, it took me a long time to get it through my own thick skull that this is something that I need. I do have now a couple of different disability insurance policies because I just eventually had to get, I got it, right? It suddenly the light bulb went off in my head where I said, if I don't address this issue and I end up disabled at a young age, it's the ultimate whoopsie that I can't go back on.
Yeah, and you're right, CJ. And that the thought popped into my head as you were talking of you haven't passed away, so you're still here, no paycheck, but you still have expenses, right? You're still going to eat and still going to do some things depending on the extent of the disability. The last point on that is even if you have disability insurance available through your employer on a group option, you still can look at options outside of that because in some of those cases, if it's paid by your employer, that benefit is taxable. So it's important to take a holistic look at that and just doesn't mean that you need it, but I think it's important to consider it, look at it, how important is it, and what kind of impact would a disabling event have on the financial plan. Now, as we move into 50s and beyond, 50s through 70s and even beyond that, there's really we start to get into this stage of life where we're still working, our income is hopefully, starting to or continuing to grow and maybe peaking, still saving for retirement, although now it's a little bit closer. We were talking beforehand, I turned 50 this year, so I'm that retirement is closer, although with 5 kids, I still have plenty of time to work. But some of these things are starting to creep into my mind. And so looking ahead to retirement, now we're also trying to, if you haven't taken a look at some of the plans for the next 20 years, this is where this starts to take place. So for example, your life insurance policies or disability insurance policies, I was asked, when was the last time you reviewed those? And not just review it as in looking at the statement, but actually a deeper dive. And in some aspects, do you still need the insurance? A disabling event, maybe if you become disabled, you're set up financially well enough that you could just simply retire. And so you no longer need the disability insurance policy. Your life insurance policies, back to the conversion, should we consider converting the term policy to a permanent. Or if you have permanent insurance, maybe you were sold a massive, large whole life policy prior to working with Klaas Financial. And so now it's time to address this and take a look and say, do I still need this? Does it align with my goals and objectives? If not, could we reposition this in another way, or could we simply surrender it? What are the implications of that? How is it performing? Is it performing like it should have? Has my health changed, perhaps for the better? Did you quit smoking? Have we know more about diabetes and heart disease and all these other things in the medical field because of science and advancements in medicine? And so perhaps, believe it or not, we've seen rate improvements for clients as they get older because of some of these advancements. So taking a comprehensive review of your life insurance portfolio, disability policies is really important. Estate planning, as we look out, it doesn't just mean estate taxes. It also incorporates charitable giving. Wills and trusts, revocable or irrevocable. What does that look like? And who do you want your assets to go to when you pass away? So getting all of those things lined up. And then in addition to that, of course, healthcare, and that includes Medicare and Medicare supplements, and also long-term care, which we'll touch on a little bit more in detail here in a minute. As we talk about estate planning, this is the place where permanent insurance may actually creep up a little bit more. If you're in a position where you have an estate a net worth that is subject to federal estate taxes, you exceed the threshold, then potentially life insurance could be a solution there to help offset those taxes. Or if you're in a state like Illinois where they have a state estate tax, and you exceed that threshold, life insurance could be utilized. And I say could because, again, I like Alyssa and CJ, I come at this from a holistic perspective. Just because somebody has a taxable estate, I don't feel like they need life insurance. I used to hear in my early days, oh, well, you exceed, gosh, and back then I think it was like 2 million or 3 million was the estate tax
I think
threshold.
it's a
So
million because I'm similar age to you. When I got in, it was about a million back in the day.
yeah, yeah.
It's not like, for those who don't know, the federal estate tax is about 13, $14 million now, so it's a lot higher. I
Yeah.
should say the federal estate tax limitation, you have to exceed that number before you have a federally taxable estate. But in Illinois, it's 4 million.
Yeah. Yeah. So I used to hear early on, well, you have an estate of 5 million, 6 million, so you should buy life insurance. Well, maybe we should have a conversation. There are different ways to help ease that tax, but again, bigger conversation. But I wanted to just bring that up because insurance can be utilized and have a pretty good rate of return. And that'll be maybe the last point that I'll leave you with as we continue to transition to the next slide in a second. This is where life insurance, in the early years, it's really more viewed as a cost. I pay X amount of premium for X amount of benefit. And so it's how can I pay as little as possible for the largest amount of death benefit? Now, I'm not going to suggest that cost doesn't ever, it's not part of the conversation as you get older. It still is. But now this becomes more of a rate of return or what's the return on the premium. So in other words, what is it worth looking at a life insurance policy to pay estate taxes just simply based on the rate of return of the death benefit? So it becomes a little bit more of a value and less of a cost. So I'll leave you with that, and then I think we can go on to the next slide and dive a little bit deeper into long-term care plan. Oh, no, that's right. I forgot about this. So we talked earlier about be your own banker is sort of this concept that's thrown out there. Now, I'm not suggesting that these ideas out here, these strategies of premium finance and life settlements are necessarily bad, but they are, as I put on here, a shiny object. A lot of times in our industry, not just the insurance industry, but in the financial world, there are a lot of topics out there that get a lot of headlines, and you hear one neighbor or one friend did something, and so it sounds good, it sounds great, it may fit their situation, but it's not for everybody. And premium finance and life settlements fits into that category there. So real briefly, premium finance, this is simply rather than paying a premium out of your own pocket for a life insurance policy, you would go to a lender, borrow funds to pay the life insurance premium on that policy with the hopes that you could then eventually pay that loan back either through cash value or through the death benefit. Now, this is for massive policies. We're talking premiums of $50,000, $60,000, $100,000 a year. So it's a very niche market. Number one. Number two, there are a lot of moving parts and it can be pretty risky. So what I would say is if it looks too good to be true, it probably is. There's some really, really nice illustrations out there. And it is a strategy that we help navigate when the time is right. But I would say probably out of every 20 to 25 premium finance scenarios and cases we look at, maybe one gets implemented. And we're very, very, very conservative, and we stress test these scenarios. So the clients are well aware of interest rate movement within the policy and with the lender. So all that to say, if you see a premium finance illustration, doesn't mean you have to run and hide, but I would just say get another set of eyes on it, take a deeper dive.
And maybe, Jeff, if you can speak to it just a little bit deeper. I think one of the things that Alyssa and I often run into with clients as it relates to large amounts of cash value in a life policy where there's been a loan taken out, or a premium finance product, or people looking at life settlements, where life insurance is a little bit different than, say, a brokerage account at an investment institution, whereby in these brokerage accounts, if you don't like your investments, rebalance them. If you don't like what the custodian or the investment options, transfer to another account. Now, that's not to say there's no implications of those decisions. Certainly, selling at a low point, you could have a loss. If you sell at a gain, there's capital gains to be realized there. But there's some level of kind of like, if I don't like it, I just change it. When it comes to life insurance, and especially premium finance life insurance or cash value, where you're banking on yourself and using loans of cash value out of that, I think what people need to hear from my perspective is if that doesn't work and you decide to pivot or cancel that policy, I cannot emphasize this enough. It could be a bomb in your personal financial life. It's an explosion. And I think that's the key. Now, Jeff could get into more detail, which we don't have time for, in terms of where the explosion would happen, why the explosion would happen, what does CJ mean by explosion. But ultimately, a lot of these products that sound too good to be true, they assume you will never change your mind over the next 60 years and just die with it the way that it is. And for us as financial planners, seeing how people's lives actually play out, the notion of making a 60-year irrevocable decision freaks us out a little bit. So I think to Jeff's point, it's not that any of what we're talking about is bad. Premium finance, not bad. Life settlements, not bad. Whole life policies filled with a lot of cash, not bad whatsoever. They just can end up being bad if you didn't understand them from the get-go and if you put too many of your eggs in that basket.
Yeah.
Do you have anything you'd like to kind of add to that, Jeff?
Yeah. I'll wrap up by saying with premium finance, especially, it has to be flexible enough that you're not stuck in a scenario where you're locked in for 20, 25, 30 years. Now, it is a longer term, so you're not going to get out of it in 5 years. So you have to be aware of that. So we are big proponents of if you're going to do it, number one, you have to have the liquidity to post collateral, right? So if something does go awry, you can pay off the loan if you have to. But you also have to be aware of the different levers in there. As I mentioned, the interest rate, both from the lender and from the insurance company. And just know that make sure it's been stress tested so you understand what could happen, the risks involved, and that there is flexibility to get out of it if you have to. And then if you have to, you know what the impact could be, especially from a tax perspective. Life settlements, you might hear life settlements or viatical settlements. Viatical is really more of well, let me back up here. both involve selling your life insurance policy to a third party. And that third party is going to then retain the death benefit upon your death. But in return for that policy, you get cash. So it could be a scenario where the cash is needed today, or you have a term policy. This is really sort of, there's two scenarios where I see this. One, somebody has a term insurance policy. They no longer need it. They're in pretty poor health, but they could sell it, convert it, and then sell it on the open market for cash that is that they wouldn't have had otherwise. A scenario I'm actually working on right now is a couple. It's a joint policy. The husband has some pretty significant health history, probably a life expectancy of less than 3 years. And the premiums are starting to skyrocket. So they're looking at, how do I get out of this? Because we don't want to pay the premiums anymore. And it's a pretty sizable death benefit. Fortunately, unfortunately, his wife is in really good health. I say fortunately, she's in good health because obviously we prefer that. The life settlement market, though, does not. So they're not going to get a good offer because it's all about a return for the buyer. I'll say that. So, in other words, they don't want to have to pay a lot in premium for a long time to then reap the reward in their minds of the death benefit. So, what I would say for viatical settlements and life settlements, again, if you hear something about this, somebody proposes it, you see an article, an ad, just ask questions and dig a little deeper. Again, probably one out of every 20 to 25 settlements that we see actually comes to fruition. So, and with that, I think as we transitioned out of sort of, not out of, but we continue to transition into our 60s and 70s. We've actually seen a shift in long-term care planning into people in their 50s, kind of because of the sandwich generation. Parents are starting to need care, still taking care of your own kids at home. So you've got some care that's being provided on both ends there. And I think long-term care has been around long enough now that there's a lot more education today than there was many years ago when I came into the industry. And I think it's important. I am a huge proponent of talking about planning, not just insurance. So just because somebody's 55, 60, 65 does not mean that long-term care insurance is necessary. I think it's really, really critical to talk about where would you like to receive care if in fact you needed care. I think most people, 90+% of people, the answers I hear are at home as long as I can. Well, that's great, but if you need care for a couple hours a day, a few days a week, then it's expensive, but it's manageable generally. But if you want to stay at home as long as possible and you end up needing 8 hours of care 6 or 7 days a week, that's really expensive. At $25 an hour, maybe more, depending where you live, that can be really expensive. So where would you like to receive care? Who's all going to be involved? And not just the care provider, but who's going to help provide, if it's husband and wife and one person is providing some care, how much care can that spouse actually provide? Both from just a physical perspective, but also a mental perspective. There's some exhaustion that occurs with this. But then also, who are going to be some of the other people? Children, sisters, brothers, aunts, uncles that are going to help coordinate where the care is received. As I mentioned, family caregivers, goals for your estate. Are you okay spending all of your money for care? And if so, that's okay. Or would you rather your estate, your wealth transfer on to the next generation or give it away to charity? So what does that look like and how does that play into if you had to pay for care out of your own pocket? And which is really the last point there. Are you comfortable self-insuring or is insurance an option you would like to consider?
Let me speak to this a little bit, everybody. This is deep into the weeds of what we as advisors spend a lot of our time dealing with our retired clients. So for those who don't know, one of our kind of specialties is retirement planning. Now, I don't say that um, just because our clients are older. We have actually done a lot of continuing education and digging into retiree planning issues, we'll call it. So one of them is this space of long-term care planning. So if you think about kind of the life cycle that we were talking about before, where I am young, if I die, for my own family, it represents a huge risk to them. So I have term insurance to cover that risk. I also have disability insurance in case I become disabled. But as we move further on into life, if you decide, I don't need life insurance, I've replaced it with a couple $1 million portfolio and my home is paid off. And if I die, I'm sure my spouse will be sad, but outside of being sad, he or she will be fine without me from a financial perspective. Well, if you actually think about where the risk has pivoted at that point, the risk is not your death. The risk is actually the absence of your death. Think about that. What if I live a long time, but in an unhealthy state that requires some form of skilled nursing care, and my cost of life skyrockets? If you actually look at research on this, cost of care for retirees is pretty, level. And then in the last 5 years of life, if you look at Americans, it skyrockets. That's actually skilled nursing care at the end of life. Here in the States, the cost of care, of skilled nursing care, gets very expensive depending upon the setting that you are in. So really what we often see is that people that used to have life insurance really probably now need more. If they need insurance at all, they need to pivot to long-term care insurance. So Jeff can attest, we have spent a lot of time with our clients saying, hey, Jeff, Jim and Sue Smith have this old policy that was a whole life policy. Maybe it was wrongly sold, or maybe it was appropriately sold, but they just don't need it anymore. And it's got $150,000 of excess cash inside of it and a $400,000 death benefit. And certainly, if they die, they would love that $450,000, but they also are stable otherwise in their financial life. We will often work with Jeff and his team at the Palladium Group to say, what other options are available? Could they 1035 exchange, which is a tax-free exchange of the cash of that policy, into a long-term care benefit that maybe downplays the death benefit, because that's not what they need, but it upplays the long-term care insurance aspect. Now, there's a lot of caveats to all the things that I'm saying. You have to work with somebody who really knows what they're doing in this space and make sure it's to your benefit. Sometimes it doesn't work out. But I hope you all are kind of getting the sense of this is what we spend a lot of time evaluating. And finally, in working with a planning firm, here's where it gets really different. If you go talk to an insurance agent off the street, they're going to sell you the fear of long-term care. And I could right now tell you how afraid you should be. Do you realize it could cost you $10,000 a month for an unknown amount of time into the future? Here's the fear, right? And while that may be true, what they're not saying to you is, oh, and by the way, you have a $30,000 a year pension, you have 70 grand a year in Social Security, and you've got a $2 million portfolio that's going to cover like 80% of that risk already. You only need a small long-term care insurance policy to cover the differential. That is a planning first solution to long-term care. If you go direct to the agent, they're going to sell the fear because the more you pay in premium, the more the commission. If you go through a planning process, then you end up getting something that is appropriate to cover the actual risk itself. I cannot emphasize enough, if there is one type of insurance that we believe you should be working with your planner first on, it is long-term care insurance. Now, a lot of great solutions. Jeff can attest it is a risk. It is something that can definitely cause your estate to go down at the end of life. So these are real risks, but you need to find solutions that fit the need instead of solutions that fit the fear.
Yeah, boy, and I couldn't agree more, CJ. It is absolutely that. It's and that's why I say it's about planning and not the insurance product itself. Um, it's important to take into considerations. I mean, first off, we're managing a risk that may or may not happen. So I'm not a huge proponent of these large policies with large monthly benefits and lifetime durations. I don't even think there's maybe one or two companies that even offer that anymore. But these large policies for something that may not happen, And so more of the planning that we see is just like you said, CJ, it's in line with the planner and the financial plan, taking into consideration cash flow and other resources. Um, and oftentimes having something that maybe helps co-insure. Maybe it covers 50% of the cost for long-term care, depending on where you live and things like that. So it is super important to take a look at it from a holistic perspective. And know this too, when we talk about long-term care, it's not just nursing home care. It does cover the whole spectrum of home health care, assisted living, adult day care, hospice, and nursing home. So all of it, if we get into insurance, then it does cover, insurance today covers all of those different settings. All of the policies today, it's become so regulated for a good reason that all of the plans really, the way they pay benefits are the same, where they pay benefits are the same. They have the same type of functions and features internally. There's some nuances between different companies and plans, but by and large, they're all very, very similar. It's really now about if you're going to consider insurance, what's the best solution for you? And that actually leads us to the last point. And CJ touched on one of the options. Alyssa, if you could forward to the next slide, please. So here's a box. I have sort of had to cut and paste a little bit here. So I'm going to go from bottom right counterclockwise. I'm going to start with traditional long-term care insurance. So this is probably what most of you have seen or heard about. This is just pure insurance. Pay a premium. If you need care, you receive a benefit. If you don't, there's no benefit. Just again, like auto, home, term life insurance. So it's the classic traditional long-term care insurance that many of you have seen. John Hancock, Genworth are big names historically in this space. So that's the pretty basic type of policy. What has happened before I get there, the other life insurance policies can provide an accelerated benefit. So if you think traditional permanent life insurance policies, some of these policies now have a long-term care rider where you can actually accelerate or use the death benefit for long-term care needs. This is really more of a life insurance focus with a benefit for long-term care. I'll be honest, I don't see a lot of these. I don't think they're as attractive. They can be, but not as we get into 50s, 60s, 70s. One of the things that CJ started to touch on a little bit is more of this linked benefit life hybrid or linked benefit annuity. These two vehicles, whether it be life insurance or annuity, we call them hybrid because it's a life insurance or annuity chassis, if you will, really designed for long-term care. So if you were to look at this and you compare premiums on a life insurance policy to a linked benefit life hybrid policy, you're not going to see the same death benefit. You're going to see a much lower death benefit on these linked benefit products. It's because they're designed for long-term care. Where these can come into play, specifically on the life insurance side, is what CJ referenced, is you might have an old permanent life insurance policy with some cash value. You no longer have a life insurance need. Maybe you're thinking about surrendering it, which could be a solution, or you could do a 1035 exchange to a life insurance linked benefit hybrid policy. So tax-free exchange, and the additional benefit here is if there was any gain in that cash value, taxable gain, if you surrendered it, if you need long-term care and you start receiving benefits, all those benefits are income tax free. So now you don't have to pay a tax on the gain on the cash value, and you've repivoted this to potentially solve a risk that's out there. The same can be said on the annuity side, where maybe you have an old non-qualified annuity, pretty substantial taxable gain if you surrendered it, but you don't really need the annuity. It's pretty expensive. You can repivot this into a hybrid annuity, long-term care annuity that, again, if you need care, those benefits are income tax free. And one additional benefit, unlike life insurance, you can add a co-annuitant. So if you're married, so on a lot of these, I'm getting kind of in the weeds here, and I'll wrap up here. But the exchange has to be like to like, meaning husband, husband, wife, wife. So the both products have to be owned by the same individual as they were previously. Well, on the annuity, you can add a co-annuitant or a second person who can receive the benefit as well. So you can really leverage those non-qualified annuities to receive income tax-free benefits and potentially insure your spouse as well. We could really get in the weeds here. Know this, I think this is maybe the takeaway. There are a lot of options out there, and as CJ referenced, as you get into long-term care planning, work with your planner, understand the options that are out there, if it even makes sense to consider insurance, and then what type of insurance could be best for you.
Yeah, let me jump in here at the end. So we have become, as an organization, huge fans of these linked benefit hybrid life or hybrid annuity policies, for all the reasons that Jeff already mentioned. But I'll add on another, which is in the traditional long-term care space, which is that lower right quadrant of these four cells that we're looking at. Often those premiums are not what are called guaranteed. It's a benefit that might have an inflation rider that the benefit keeps up with purchasing power over time, but that means your premiums can also change. And I will tell you, from a financial planner's perspective, that's a tough nut to crack. When you go, we're going to insure you appropriately for the right dollar amount. And by the way, I just don't know if that premium is going to double over time. Who knows? That's an extreme example, but I think everybody gets the point. On the linked benefit side of things, you can often get a flat premium, a guaranteed premium that's not going to change. Now, you also often are not getting an increasing benefit, so it's a locked benefit that basically over time is going to dilute in value due to inflation. So there's pros and cons of either. Jeff can attest. There's definitely, you want to be aware of what you're buying and what really matters to you within the financial plan. But there are just so many more tools than used to exist than when, Jeff and I got into the industry. You can now ratchet up the death benefit and down the long-term care, ratchet down the death benefit and up the long-term care. And these products really allow for a customized solution that just didn't exist before. So big encouragement for everybody. Pause before you blow up a non-qualified annuity, or pause before you take a life insurance policy and just say, to heck with it, I'm just going to take out the cash and move on. We would say there might be other solutions that could be better benefits that offer a tax-free income stream instead of getting clobbered with some taxes. Yeah. So, Jeff, spectacular. Appreciate you big time. Thank you so much for going through this. Alyssa, why don't you make the pivot to some of the questions?
Yeah, so we did have one come in asking how a disability benefit works and whether that pays for the remainder of someone's lifetime. So maybe the process of actually qualifying and what the logistics look like from there.
Yeah, that's a great question. So it depends on how the disability policy is structured. A disability policy is going to have a certain benefit period. It could be a 5-year, 10-year, 20, sometimes age 65, 67. So there are varying disability benefit periods. And so based on how the policy is structured, yes, once you become disabled, then that benefit will pay as long as you are unable to perform the duties of your occupation or any occupation. So this gets a little bit in the nuances of the qualifying status of it. The classic own occupation means that you can no longer perform the duties of your occupation. There is the probably the lowest tier. I don't mean that in a negative way, just in terms of there's an any occupation clause on some policies, meaning if you can perform any occupation, then the policy won't pay benefits. But if you can't perform any occupation, that's a pretty severe disability, then the policy would pay benefits. So there's sort of two components there. How do you qualify? And that's based on the physician, your primary care physician, and the definition of disability, and then the duration in which your policy is structured, if it pays out to age 60, 65, 67, etc.
And Jeff, correct me if I'm wrong, but often those disability policies, they have an army of attorneys that once you get to certain ages, they're gonna, well, I shouldn't say this. Regardless of your age, they try to push you out to Social Security disability to reduce the amount of costs coming from the insurance company itself. Is that true, or what does that look like?
It can, and we typically will see that more on group policies,
Okay.
not individual disability policies that you'll see in the traditional retail market.
Yep.
Um, and Social Security, that's a if somebody's going to bank on qualifying for Social Security disability, bank on a 6 month review process first, and then a
Yep.
denial, and then another 3 year review process. So
Yep.
it could
Yep.
be upwards of 4 years before you actually receive benefits from Social Security, if at all.
Well, I think the point I'm making is that what we've seen is if people qualify for disability, often what happens is that insurance company will pause to say, "Do you also
Mm.
qualify for Social Security disability?" Um, so I only say this to you because that can be a surprise for people as they qualify for their private disability insurance policy. And then all the meanwhile, there's this other thing happening in the background, which is the Social Security disability process as well. They are different qualifications, though, is my
Yeah.
understanding. Different qualifications, and on top of that, different expectations of timelines to qualify by
Yes.
by a wide margin. So
Yeah. Yeah. But yeah, you're right, CJ. Typically, that's on group policies where the Social Security
got
benefit.
it,
You won't see that on your traditional retail
got it,
policies.
got it.
Okay, and one more. So if somebody receives a notification that their premium for their long-term care is increasing, do they have options aside from continuing to pay the increased premium?
Yes, absolutely. So there's two. Not only do they have options more than what they typically would receive in a letter. So the policy owner would typically receive a letter outlining A, the increase if they want to maintain the benefits, or B, two, three, four options that they might consider. But as you all might imagine, there are thousands of policyholders, thousands of different benefit structures. So they can only show, right, understandably so many different options on a piece of paper that they send out to thousands of insureds. So, yes, there are alternatives, and then there are alternatives beyond what's included in the letter. So I would say consult with your planner, insurance professional, take a look at those, and then potentially call the insurance company and say, what if I did this? What if I reduced the benefit period to 3 years instead of four, or the inflation from 5% to 3%? So playing with some different levers in there and understanding how those levers impact the premium is also important.
I'll echo what Jeff is saying. We've started doing this more and more with because our clients will get letters saying rates are going up. And through the financial planning process that we do, we can see if they have room to reduce the benefits so that their premium can stay more in control. And instead of just relying on the options that they gave to you, we've started reaching back out to the insurance company to say, hey, we know exactly what we're looking for here in terms of the benefit reduction amount. And it's amazing. They're quite responsive actually because they want to see some sort of an adjustment. And so just cannot suggest to you enough if you're not working with an advisor or if you have an advisor here at the firm and you get one of those letters, sit down with your advisor because often they'll suggest you go back to the insurance company and get a custom, kind of a custom solution instead of one of the formulaic ones they put on the form.
Yeah.
Great. And I got a thank you shout out. So thank you to Jeff. Thank you for your time. And I think that'll move us on to wrapping up. So as a reminder, this was recorded. This will be sent out if you have anybody in mind you maybe think could use the information or recap for yourself. We do have another great webinar coming up on March 10th for Social Security with our guest Megan Forrestal. So if you haven't signed up for that yet, highly recommend doing so. And if that is all, yeah, thank you all for joining and thank you again, Jeff.
Thanks, Jeff.
Thank you.
Bye, everyone.
Have a good night.
Bye.